Hi, everyone. Welcome to the latest episode of the ETF Exchange, brought to you by the NYSE. I'm Douglas Jones, joined today by Perpetua Seidenberg. She's a managing director for Vigilant. Perpetua, thank you for being here today. As a reminder, this interview is for informational purposes only. The NYSE does not promote or recommend any investments or investment strategies. Perpetua, Vigilant has just produced an excellent resource guide for advisors or those thinking about coming into the marketplace. And I want to kick right off as you start to, in the guide, talk about the key differences across exemptive relief requirements for ETFs, as well as this new rule some of us call SEC Rule 6011 or the ETF Rule. Could you talk about what are some of the things that advisors thinking about coming to the ETF market should be considering?
Great, thank you. Thanks for having me today, Doug. So we've obviously seen substantial growth in assets within ETFs in recent years, with the current size of the industry being over $5 trillion in assets. And experts are estimating that that number may reach $50 trillion by 2030. So really what we saw from 6011 was that this rule came out of necessity. It was really to bring some standardization to the industry, which we feel that was definitely needed. So with the new rule, though, also came increased regulatory requirements for advisors who are already operating ETFs or who plan to operate an ETF in the future that weren't applicable prior to exemptive relief requirements. So as you know, the rule became effective in December of 2020 for current ETF managers, but those who are looking to bring a new product to the market should know that there are some key differences. So the main key, I would say, with this rule is that the goal of the SEC was to bring additional transparency to the ETF process. So before, advisors were just required to post their daily holdings to the website. Now they have enhanced requirements where they're posting bid-ask spread information on a daily basis, as well as premium and discount information on their website as well. In addition to that, they're now required to post information on 2% deviations to their premium and discounts if that occurs for more than 7 consecutive days. So really an additional level of transparency there and additional information for investors to have access to. In addition to that, I would say another big piece is the custom baskets portion of the rule, which really enhanced processes and procedures around custom baskets and record keeping requirements around those as well.
Yeah, I know custom baskets were something the ETF industry is really excited about heading into the publication of the rule. I am curious, when you're looking at that from Vigilant's point of view, are there special procedures? Are there ways that you're finding compliance teams, portfolio management teams need to be communicating now using these custom basket procedures?
Absolutely. So I think with the new custom basket process, it's really important for both the advisor's portfolio management team and compliance to work closely to establish a process on the acceptance and oversight of custom baskets from prior to what was required before. It's really essential that compliance work with the portfolio management team to really have a process set up for acceptance of the baskets and then periodic testing to ensure that there's not inappropriate differential treatment of authorized participants or that they're not complying with their policy that they've originally laid out. Again, I think the goal of the SEC was to provide some flexibility for advisors here with custom baskets, but at the same time to ensure that the interests of investors are still protected.
Yeah, now Perpetua, for advisors out there, they're thinking about ETFs or as we're starting to see, even as recently as in the last couple of weeks here, they're starting to think about converting direct from a mutual fund into an ETF that they've been doing here at the New York Stock Exchange. Are there ways in which Vigilant will help those advisors? Can you talk about some of the services you offer for someone who's thinking about coming to the ETF industry?
Absolutely, yeah. So often what we see with the new rule, when a new rule comes out, is that advisors will typically use standardized language around their policies and procedures that don't really match the advisors practice on a day-to-day when they're managing the ETF. So our goal with our clients is to really focus on tailoring their procedures to their business practices, but we also help them institute a strong but manageable process of oversight and review from a compliance perspective. So that way, if an advisor is selected, for example, for an exam and they're being reviewed for 6C11 compliance, the advisor has the comfort that they're following both their own procedures, but that those procedures also align with what the rule says and are not just an off-the-shelf policy. So at Vigilant, we really work closely with our clients to give them the knowledge and tools that they need to comply with regulatory requirements, and Rule 6C11 is really no different.
Well, that's on the latest episode of the ETF Exchange. As a reminder for those interested in learning more, Vigilant has published an excellent resource guide on everything about 6C11 or the ETF rule. I'm Douglas Jonas, your host. Thank you very much for joining us for the latest episode of the ETF Exchange, brought to you by the NYSE, the home of ETFs.